Good morning and welcome back to NWR's Vantage Point Conference. Up next, we have Jamie Twist, the CEO of Beforepay. Before I hand it over to Jamie, I remind you it's a relatively brief presentation before we run into a more interactive Q&A session. Just a reminder, you can ask a question via the Q&A function at the bottom of your screen. Jamie, I'll now hand it over to you.
Terrific. Well, thanks, Max, and good morning, everybody, and thank you very much for joining me this morning. I'm delighted to be talking to you about Beforepay. So, as Max mentioned, my name is Jamie Twist. I'm the CEO of Beforepay, and I'm going to spend just a couple of minutes explaining who we are and what we do, and then I'll talk through some of our recent performance and what comes next from here, and then very much looking forward to your questions. So I'll start by just talking briefly about what it is that Beforepay does. And I'll start by explaining at a high level that we are an ethical lending fintech. So we exist in order to give Australians safe and affordable financial products, and particularly in the short-term lending space. The most common reason people need to borrow money is because they are short a relatively small amount of money, a few $100s, and they would like to borrow a few $100s for a few weeks to fix their car, to pay the vet bill, or just because they got a little bit overextended during busy times of year like the holidays or back to school shopping. Now, historically, the products that the financial services industry has provided to people in that situation have been not at all fit for purpose. A bank will encourage you to take out a credit card, and they rely on the idea that you will then have quite a significant amount of money that you borrow from them for quite a long period of time. Their cost structure relies on that. Or even worse, you could go to a predatory lender, such as a payday lender or a pawn shop, and borrow money from them. And that is a very challenging and difficult thing to do. And I think we all are well aware of the predatory nature of that kind of lending. So Beforepay's core product is what we call pay on demand. And this is essentially a short-term small dollar lending product. The average loan size is about $350, and the average duration is 3 or 4 weeks. It is designed to be affordable, so we charge a flat 5% fee, so there's no compound interest, there are no late fees, there are no tricks or traps of any kind. And then even more importantly, it's designed to be safe. So because we only charge that 5% fee and there's nothing more to pay, if you borrow $200 for us, I can promise you that you owe us $210 and that figure will never change. So it immediately takes off the table that risk of getting into a debt spiral or ending up in a difficult situation like that. It's worth noting that we are very much not a buy now, pay later. So there's no third-party merchant involved. We work directly with the customer. We provide the money directly to them in their account, and we charge them a fee ourselves for that. So that's what we do. We've been in the market coming up on 3 years. Our commercial launch was in August of 2020, and the take-up has been fantastic. The customer loyalty and advocacy are very, very strong because it is just genuinely a better way, of accessing short-term finance. Now, as you can tell, I'm very, very passionate about our mission and about our values. If we had more time, I'd spend more time going through that and explaining how we got to where we are. But given the nature of this conference and also the time available, I'll quickly move into talking about our performance as a company. So I'll go through these slides fairly quickly, but suffice it to say that every slide we have goes up and to the right pretty quickly. So this one is the number of registered users. This is as of December 31, we're at 203,000 active users. As of March 31, the last quarterly results we put out, that number was 222,000. So the growth is very strong. Again, customers like it. They come back and they tell their friends. And so we've been very pleased by the rapid uptake that we've seen in the market. Default rates have come down very sharply. So when we first began and we were feeling our way forward on risk decisioning and credit decisioning, we had obviously quite high default rates, and we've made a very heavy investment in data science. And I'm happy to talk more about how we make those risk decisions. At a very high level, what we do is when you download the app and you apply, and it's a 100% digital process, we take your line item bank transaction data and we run all sorts of algorithms over the top of it. I know these days everybody says they have artificial intelligence and machine learning. We actually genuinely have artificial intelligence and machine learning, and I can talk you all through the algorithms in as much detail as you have stomach for. And you can see the results here, where we've seen a very significant and welcome decrease in those default rates over time. You can see at the end, there's a little holiday bump in Q2 of each year. So you see that in FY22 and FY23. And that's come right back down in Q3 of this year. And we feel confident about our credit positioning going forward. And again, I won't show you all of the charts. These pages all come from our half-year results. And so you can see many more like this. But this is what we call our net transaction margin. This is essentially a gross contribution number. So this represents our revenue less the defaults and then the variable costs of the loan, including funding and other costs. And you can see if you look half on half, we went from losing money on each loan in FY21 to being profitable on a unit economics basis in FY22 to a very significant contribution in the first half of FY23. So the product is working for the customer and it's working for us as well. We've got defaults in a good place, and as a result, the contributions are positive and we're well on track to profitability. Talk a little bit more about that path to profitability. So obviously, the market is very keen for any fintech, I think, and any startup to get to profitability as quickly as possible. We have heard that message very clearly, and immediately following our IPO in January of 2022, we were clear communicating to the market that our focus was 100% about grinding away to profitability with the current product in the current market. So while we have been growing extremely rapidly, we've done so in a very cost-conscious way, with that goal of using the money that we have from the IPO very efficiently and responsibly, bringing down that burn rate and being able to self-fund growth going forward. We've been very successful in that. I'll show you those numbers on the next slide. To explain how we think about our path to profitability at a very high level, it's the volumes that we put out each month times that margin, that gross contribution margin, and those two things have to be greater than our overheads, as you'd expect. We've got the individual components here on this slide that shows how those different things fit together. I won't go through that in too much detail. Again, this slide is in our half-year results for the first half of FY23 on our website or on the ASX website. And you can go into more detail and see some of the definitions in there. But essentially, volumes times margin has to be greater than our overheads, our operating expenses. And the good news is we have been very successful at driving all of those numbers in the right direction. So if you look at that top purple line, that's the pay advances quarter on quarter. And you can see that very rapid growth coming up in pay advances in terms of what we advanced. In the last quarter, we advanced $161.9 million to Australians, to those 222,000 active users. You can then see the elements of each piece of that margin below, and you can see that net transaction margin percentage. You can see that it was higher in Q4 and Q1, and then we had that holiday bump up in defaults, and then it's coming back down again. So that net transaction margin is a very healthy north of 1%, kind of headed towards 2%. So the growth is good, the margins are good. And then perhaps most surprising and pleasing of all, our operating expenses have actually come down quite a bit. You can see that 5 quarters ago, our operating expenses were $6.4 million, and in the last quarter, they were $4.2 million. So I know that every digital business tells you that it has fixed costs and it will take some money to build out the platform, and then it's zero marginal cost after that. We have shown that we are actually able to do that. We have actually gotten that operational leverage. You can see that our overall costs have been flat and even declining. So when I put all of those things together and I think about what comes next, so the first thing I'd say is we absolutely expect to continue growing. We are nowhere near touching the sides in terms of the need for this product and the demand for this product. Our existing customers are very loyal and sticky. Our growth continues to be very strong. At the same time, we're very focused on keeping those unit economics healthy. They are healthy now, and we'll continue to focus on that, while also keeping those costs flat or indeed even down. So we feel good about our growth, we feel good about our unit economics, and we feel good about our operating expenses. We put those three things together, and then we feel very comfortable with the path towards profitability. In the last quarter, Q3, our EBITDA loss was $1.6 million, and we had $25 million of cash in the bank. So we feel very comfortable with our runway and our prospects from here. So in terms of what comes next, look, we are going to be boring in a good way. We have no planned pivots, no changes in strategy, nothing terribly different, just that relentless focus on doing everything a little bit better every day, continuing to maintain that high rate of growth while also maintaining attractive unit economics and keeping costs tightly constrained. When we get to profitability off the back of that, we think that will then open up a new set of growth options for us. And we think there's a lot of exciting stuff that we can do on the product front and on the geography front. But for now, we are very focused on pushing forward with what we're doing today and getting to profitability. So that's a bit of a whirlwind tour of Beforepay. Very happy to dive deeper into any of that, or indeed take questions on anything at all that you might have.
Thanks, Jamie. And just a quick reminder, you can ask a question via the Q&A function at the bottom of your screen. First one up is, will recent discussions of changes to the Credit Act to include buy now, pay later products impact Beforepay?
So I'll give you a two-part answer to that. So the first one is, we don't believe it will. So our understanding of the government's intention with these regulatory reforms is that it is looking at buy now, pay later as one type of alternative credit product. And in the consultation paper that they put out several months ago, they explicitly talk about buy now, pay later as opposed to what they call wage advance products, which is what we do, and then several other categories as well. So I don't believe it's the government's intention to pick up our sector in that. Now, having said that, we have always assumed that there will be regulatory change coming to our sector. And so we have always run this business on the assumption that in the we have to be prepared for a range of regulatory outcomes, ranging from status quo all the way to full compliance with the Credit Act. And so we operate in such a way that if we were required to make those changes, we feel comfortable that we would be able to do so without significant change to our business model, to our product or our business model or our economics. So we don't believe it affects us, but we're certainly prepared if it were to do so.
Thank you. And just a few questions around sort of the economy and customers defaulting. Are you witnessing rising customer defaults given the difficult economic backdrop?
So we haven't seen all. We can certainly see the rising cost of living and inflation come through in our data. And we are, to the best of my knowledge, we're the largest aggregator of banking data in Australia. We have a large user base. And the way we do our risk decisioning, as I mentioned, is we link up to their bank accounts and we see their transactions in real time. So we have an excellent front row seat to what's happening in the economy. And in fact, I believe the first macroeconomic data available in Australia each month is the Beforepay Cost of Living Index, which we put out right at the beginning of each month. So we can see that strain coming through a little bit. Employment and wages continue to hold up quite well. And so as a result, we haven't seen that flowing through into a significant change in credit performance from our customers. We're always on the watch out for this. And because of the very short duration of our book, we are able to make changes quite quickly when needed. And the way that we set our limits, without getting too technical, is we look at the elasticity of defaults for like cohorts of customers. And so we optimize the lifetime value of the customer based on the actual credit performance we're seeing, both at what we're lending them and then if we were to lend them less or more. That process, it's certainly not automatic. There's quite a bit of manual work involved, but that process means that should we see stress start to emerge in the portfolio, we would pull our limits back, again, not quite automatically, but almost automatically to hold those defaults down. Given that the duration of the book is less than a month, it's sort of 25 to 27 days on average. If that were to happen, that stress washes through the book quite quickly. So we feel very comfortable as we head into this macroeconomic climate that we will be well positioned, whatever happens from here.
Thanks, Jamie. Given you don't require security on your pay advances, have you experienced limited ability to enforce contractual rights or recover against defaulting customers who have other creditors?
So we are very much a mission-driven organization. And so our goal is to be helpful to our customers, and we only want to lend to them when we think it will be helpful to them and obviously safe for both us and for them. Sometimes customers cannot pay us back for a variety of reasons. We generally find that the best approach to that is a friendly and customer-centric one, not an adversarial one. So if a customer is unable to pay us back, especially given the sums of money involved, we aren't going to take a threatening stance with them or call a lawyer or anything like that. What we will do is ideally work with the customer to help them understand what they are able to do. And then also just to remind them that we are still out there and they still owe us that money. And we find that actually works reasonably well. If you look at the spread between our gross default rates and our net default rates, you can see that a pretty significant portion of the defaulted money does come back over time as well.
Thank you. Just to touch on rising rates, are you vulnerable there?
So I prepared this one before the show. The book is very short duration in nature. So we have an external debt facility with an 80% advance rate. And that's currently running at an all-in cost of just under 12%. When you look at that average duration, what you see is that the actual funding cost for our book is not terribly significant. It's not nothing. I'd always rather pay less than more. But even in a rising rate environment, you can see on this slide that if we went from 12% to 13 to 14, significantly less than 1% of the amount advanced is what we need to fund it. And given that we have a margin of 5%, we feel pretty comfortable that we are protected from rising rates in terms of our own funding costs. Our customers sometimes will feel strain from interest rates. As a general rule, most of them don't have large volumes of variable rate debt. They tend not to have mortgages. Some of them have auto loans. We usually don't like to lend to somebody with a large revolving credit card balance. It doesn't feel like our product is very helpful if you're struggling in that situation. So we don't see enormous interest rate sensitivity in terms of customer credit outcomes or in terms of our own funding costs.
Thank you. And just a couple of cheeky questions here. When are you going to be profitable and what is going on with the share price?
So we haven't made any kind of forecast around profitability. What I always encourage people to do is look at the financial results that we've put out, either on a quarterly basis or on a half-on-half basis. And what you can see is that loss rate has come down pretty sharply. So off the top of my head, I think the losses over the last three halves on an EBITDA basis were 12.7 and then 8.3 and then 2.7 in the most recent half. And the quarterly numbers look similar. So the loss rate is coming down quite sharply. We haven't put a date out there or committed to a specific time when we think we will be profitable, but we certainly don't think we'll die wondering. And then in terms of the share price, I think obviously the market has had a different view of fintechs, and particularly fintechs that are not yet profitable in the last couple of years since the IPO. We're very focused on what we can control, which is the operational performance of the business. The operational performance of the business has been excellent, and we expect that over time, as we turn to profitability, that the market may well recognize that in due course.
Thanks, Jamie. Just the last few ones here is, how big is the market for what you do and how big can you get?
So the way that I think about the size of the market for the current product in Australia is there are about 12.5 million employed Australians. Depending on the exact question you ask about, do you live paycheck to paycheck or do you sometimes run out of cash, a little less than half of that working population could benefit from a product like this. So that the number of people who could benefit from the product is about 6 million. Now, we find roughly a quarter of the people who come through our door, we can't help for eligibility reasons or credit reasons. So take that 6 down to 4.5. And then some people just won't want to use this product for whatever reason. They'll do something else or go without. And so I think the total addressable market conservatively ends up in that 2 to 3 million customer range. Now, we currently have more than 200,000 active customers, but it feels like we are just scratching the surface. We certainly don't see any indication that we are at all touching the sides of the market overall. Now, having said that, when we hopefully do get to that point of reaching that 1.5 million customer number, we do think we have a lot of exciting growth opportunities, both in terms of broadening out the product set that we provide to our customers, as well as a potential geographic angle as well. So of all the things that keep me up at night, the possibility we will run out of avenues for growth is certainly not one of them.
Yeah, just touching that growth part, is looking to expand internationally, even New Zealand's one of the options there?
So we think there is a good opportunity offshore for us. And there are different markets with different pros and cons, and I won't go into all the ins and outs of which ones make more and less sense. But I would say it is a very significant opportunity for us. We are very focused on driving to profitability in Australia with our current product. The most important thing is to get to the point where we are sustainably generating cash such that we can fund our own future growth. Once we do that, then I think a lot of exciting things open up for us in due course.
So do you think New Zealand would be a natural first cab off the rank if you were to?
I feel like we've got a patriotic Kiwi on the line, hoping we'll come there first. Look, there are lots of pros and cons. A lot of it has to do with the regulatory environment and the competitive environment. So obviously New Zealand is something we would look at very seriously, but I'm probably not going to say that it's the first cab off the rank. I don't think we really know that at this point.
Can you discuss some of the business-to-business partnerships which Beforepay has in place, and are you looking to increase this line of business?
Sure. So we have two major partnerships. One is with H&R Block. And so we have a product called a tax refund advance, which enables people who do their taxes through H&R Block to potentially get an advance against that. And so we have very high hopes for that. We think H&R Block is an excellent company and a great partner for us. That's quite a seasonal product. So we look forward to seeing how that performs in tax season of this year. The second partnership we have is with Western Union. So Western Union customers see the opportunity to enroll with Beforepay and then potentially take out an advance in order to be able to send more money home, or to make a transfer and they otherwise might not be able to. And so especially if you go into the Western Union digital environment and you're logged in, you will see a banner promoting Beforepay. And indeed, when you're on the Beforepay app, when you successfully complete an advance, you'll see an opportunity to go send that money during Western Union. And that's going very well for us. They're a fantastic partner, and we're very pleased with that relationship and look forward to continuing to evolve it with them.
Awesome. Thank you very much, Jamie. I'll just hand it back to you for some closing remarks, and then we'll call it there.
Terrific. Well, so once again, I want to thank all of you for joining us today. Again, I'm very passionate about what we do, and particularly the mission that we have to help our customers. I'm also passionate about the company. I think we are operating and executing very successfully. You can see in the numbers that I put in front of you today that we are within spitting distance of profitability. The growth continues to be very strong. The unit economics continue to be very strong. The cost control has been very, very tight. Our burn rate has dwindled down to almost nothing, and we have very significant cash runway in the bank, so we feel very confident about the future. So thank you all very much. Thank you, Max, for hosting us.
Thanks, Jamie. That concludes this session.